Jérôme Bouffre, thank you. Welcome to Paris. It's a great pleasure to having you here in our office here at Reinventing Bretton, Paris. We decided to invite you because you just wrote a very interesting book here called Emerging Market in an Upside Down World that was published by Wiley a couple of months ago. And Jérôme, you might remember we met a couple of years ago. You are a strong advocate about emerging markets. So we decided that it would be a good idea at a time where we are creating a series of seminars and conferences around the 70 years anniversary of the Bretton Woods Conference to see what the global financial architecture might take in the next few years. You have been involved in emerging market for all your career in a very successful way. And that's why we felt in that occasions that this book and also your strong commitment towards these countries would be a very nice way maybe to have a set of questions to try to understand what might be in the near medium term, the stake and the future of emerging market, but also about the global monetary system and the global financial architecture. When I read your book, what I found interesting here was the way you define the emerging market. I've been seeing a lot of definition of emerging market, but you have one very specific. Why don't we start with that?
Yes, well, I define emerging markets actually in terms of prejudice. I say all countries are risky. The emerging markets are the ones where that's priced in, where the risk is perceived. And I see, if you like, if emerging markets become wealthier, then the definition historically has just changed. What we have is very much a prejudice, which I also call core periphery disease, which is more than a theory because it's a deep-seated meme which has been with us several hundred years. This idea that the developed countries, the West, is core, and the periphery, the emerging markets, we can ignore for much of the time. I mean, the basic idea of core periphery is that the core affects the periphery, but we completely ignore the effect of the periphery on the core. And we go on, driving policy as if, yes, they're affected, but they're not actually part of the policy formation. They're not key to understanding some of the big macroeconomic balances, and this is a major flaw. So I define emerging markets by prejudice, and also in the knowledge that prejudice is something very precious to us. It defines part of our character, and it's something which we don't let go of easily. Thomas Kuhn, in his very famous book, The Structure of Scientific Revolutions, talks about the term paradigm shift, which is overused since then. But when he talks about moving from, say, accepting Newton's theories to Einstein's, he notes that Einstein, even to the day he died, was very skeptical about quantum theory. And, scientists have deep prejudices and won't accept new theories. And that's much worse for our world of economics and policy. And I think what we have is something that people feel they know and don't want to explore. And this is the basic idea that emerging markets are second class, and whatever you do, there will be reasons. It's like, I think, very interesting in the case of China in particular, that it doesn't matter how wonderful their statistics are, and the fact that they're doing lots of structural reforms, there will be people who will come up with a new argument every time to why there's a problem. And that satisfies them. That gives them a sense that they no longer have to think about the awful truth that China may actually be very healthy, far too healthy for us to want to deal with emotionally.
But where does this prejudice coming from? Is it coming from the countries themselves? Because sometimes emerging markets are very timid, in order to present themselves, less vulnerable. You look back over the last 20 years, we have a lot of financial crises coming from the emerging markets. These countries made a lot of efforts in order to reduce vulnerabilities. They build up reserves, they move from fixed to floating exchange rates, they have a stronger banking sector than in advanced countries. But despite what we have been seeing over the last few months, you remember during summer 2013, again, a major volatility, and people were saying, yeah, emerging markets are the same, investors are moving away from these countries. Are these prejudices coming from the investor community, but it's coming also from these countries themselves who are not assertive enough?
Yes, I mean, it comes from the past, and it's merely supported by, and you're right, core periphery disease is very much held by those in emerging markets as well. And with that comes a sort of doublethink. You have reserve managers who are very happy to put reserves into Western bonds, which they believe very strongly is the prudent thing to do on the one hand, but on the other hand wouldn't dream of putting their own money there because they know they're going to lose money, and it doesn't. There are risks. There's risks obviously from the exchange rate movement, but also from yield curve changes, and the investors, of course, in many cases do the stupid thing first. The intelligent thing is to do the stupid thing first. To pander to other people's prejudices may be a reflection of your own prejudice, but it may also be an understanding of the structural nature of those prejudices, and that in itself builds on it. But what I think is fundamentally different today from certainly 20 years ago, I mean, thinking back to the mid-90s when you had these big emerging market crises, I think a couple of things have changed fundamentally since then. One, I mean, I remember when, for example, the 94, but then the 98 crisis, it was very clear that a third of the money invested in emerging market debt at that time was highly levered speculative hedge fund money. Another third was probably bank money, which was likewise pretty fleet of foot. And so you had this massive problem with margin calls, and you had massive contagion problems. You also had countries which at that stage didn't have the reserves they had today, yes, and which were therefore subject to this contagion impact. And countries were, dependent on, if you like, the fragility of the whole system not becoming apparent. And we've had since then some basic, changes. One, these countries have decided to turn their back a little bit on the IMF, certainly after the Asia crisis, and self-insure, and to a certain extent insuring each other with swap lines, etc., and I think that will only grow. But also the investor base has fundamentally changed, and the investor base certainly in fixed income, not so much in equities, but certainly in fixed income, which in many ways is more important, is much more institutional, much less levered, and much more stable, and importantly, much more local. In many cases, we've had in this last decade or so, the change from countries who are dependent on foreign capital to ones where they would like foreign capital merely or largely to bring transparency and competition of ideas with their own domestic capital. These are countries now which are net savers, big savers, yes, as of course we know because they've been buying Western bonds. And they are really, I think, still timid. They don't look at themselves as big reserve holders which actually probably should be importing capital. They still behave as if they should be worried about their current account deficit, and they have small reserves. And so they're too timid in using those reserves to stabilize and reduce volatility on the one hand. And that, in a way, I think may almost create more requirements for reserves. So you still, despite the very high level of reserves, you still have central banks thinking about maybe they don't have enough. And I think that's partly because the mindset hasn't quite changed. It's also because they aren't actually using those reserves in the way that they perhaps should to stabilise the exchange rates and kill volatility, which they have the potential to do. And so I think, again, coming back to your earlier remark, investors have been seeing volatility in emerging markets. Volatility is not the same as risk. I mean, I make a major point of this. I've got a whole segment of the book on the theoretical problems and the underpinning. This is really a critique of finance theory, this book, and there's a whole section on risk. And there's a big difference between when you have, say, $300, $400 billion in reserves. That means you can change your exchange rate at will at any time. If you choose not to, and as a result, Western investors who are fickle come in, go out, and creates volatility, that doesn't tell you or anybody else, an investor or an outside observer, very much about what would happen if there were a major problem. Because if there were a major problem, then I think we can see from historical precedents that central banks will act. Yeah. And I also go through the history of monetary theory since Bretton Woods. I particularly lay stress on what happened in the early 70s, that it was at that point where the central banks with the surpluses in Europe at that time really called the shots, and I don't see Nixon had much choice. And
credit
I think
your nations, Mike.
Sorry?
Credit your nations.
Credit nations hold the shots.
That's right.
Now they may make certain losses, but they make the key decisions. And today the creditor nations are emerging markets, and that's a key point which we've not quite got in our head yet.
I think you said something interesting before about the fact that we have been seeing a change in the investor base in emerging markets.
Yes.
And in fact, 2 weeks ago when I was in Washington at the spring meeting of the IMF did a very interesting study in one of the chapters about emerging market and the new investor base. In fact, what we have been seeing compared with the 1990s, you have now more stable investors. Sovereign wealth fund,
Yes.
during the summer turmoil, didn't withdraw from emerging market. They are more the retail funds. So maybe what we are witnessing here is maybe to remove the prejudice that the fact you are seeing maybe a new type of long-term investors who are willing to stay in these countries, despite volatility or questions. So is there something here that is going to be a major shift, in terms of the way we operate in emerging markets? And two, you are talking about more local investors.
Yes.
The fact that these countries build up pension funds, that these countries themselves also invest abroad. So the fact that we are seeing maybe more local debt market in these countries, the fact that investors, sovereign wealth fund can also invest in local debt market in emerging countries. So that's maybe a way to overcome the prejudice that emerging markets are going to be more on the radar screen of long-term investors.
Yes, and I don't think we're not talking about the future here.
Yeah.
This is already happening. And
Yes.
It's very, very clear that there is greater stability and huge growth in capital markets, particularly in debt markets. If you look at the size of capital markets in emerging markets compared to their economies, the ratios are much, much lower than for developed countries. And for me, that's an indication that the capital markets are going to grow much more rapidly than in the developed countries, and in fact, more rapidly than GDP growth in the emerging world, as savings, which have been high for a while, are institutionalized. More into domestic pension funds, of course, insurance companies, banks, which have been dominant already. And already, there are loads of countries, emerging markets, where the vast bulk, 80% of domestic instruments are held by domestic investors, and that gives us stability. But what's going to happen, which is new, is of course these institutions are going to start investing abroad, particularly as inflation domestically and therefore potential returns on fixed income come down. And we're seeing this in countries like Brazil and others. But also, the other point that I try to stress in my book is that central banks are already very large creditors internationally. And whilst I'm not belittling the risks facing emerging markets of sudden reversals, of policy mistakes, and we see plenty of those, what I think is also the case is that we must judge the developed world through the same prism. And when I look at countries which I call heavily indebted developed countries, the HIDICs, with much higher levels of indebtedness in many cases, and actually these countries are often much more dependent now on foreign capital than the emerging markets are. And so the roles have been reversed. And moreover, they are owing money to the central banks in emerging markets. So my fear is that our prejudice, which is very close to us, very something we hold dear, something that helps to define our characters, we stubbornly refuse to drop our prejudices. And the result is that the gap between our prejudiced view of the world and the actual reality becomes further and further apart to a point where we get some crisis. And the crisis in monetary policy would be the obvious one, the worst one, and I'm not saying this is a prediction, I hope it doesn't happen, but by highlighting it, I hope that policy can move to mitigate the risk, is that of course you get another big breakdown and reserves are flooding out of the developed countries back to emerging markets in panic. And I see a huge collective action problem in this. I think the pattern of 71 is very, very repeatable, because central banks, whilst being full of very bright, intelligent people, they're also very timid. And they're also very peer conscious. So we have, I think, a risk that if the G20 doesn't deliver on international monetary policy and monetary architectural reform, which is central to your area of debate, if that isn't delivered one way or other, then the imbalances build again and we get another crisis. And the key to this that I'm trying to get through in my book is the first thing we need to do is understand the real world we live in. And I spend a lot of time, I spend many years writing this book, because I wanted to get not just something for the investor and something for the policymaker. I really wanted to get at the depths of why we think about the world in this way. And so it starts with economics. It starts with analysis of why we come to such a very perverse view of the world. And what I'm saying in the book is that finance theory is simply not fit for purpose. It has caused massive distortions, not just in our perceptions, but in the global allocation of capital. And this, of course, is to the detriment of hundreds of millions of people. This isn't purely academic. But it also creates not just a misallocation of capital, but the potential for very large reversals now that the emerging markets are themselves large creditors. And I think it's a very perverse period of history where we have the countries in most need of capital, scarce of capital relative to other factors of production, are actually the ones exporting capital. That cannot last. And I hope that we can get to an international monetary architecture where we can actually get from where we are to where we need to be, a multipolar world with an international reserve system much more reflective of the international shape of the economy. Then we just ignore the problem, hope it goes away, give a few little sops to the emerging markets, give them a couple more shares in the IMF, hope the problem goes away, and then we get a crisis.